Now, another one is a super related one, is that you can make what we call personal deductible super contributions. Now, these are what we call concessional contributions. Concessional contributions are like your employer contributions, 9% that your employer puts into your super for you. Your salary sacrifice contributions that you're putting in, that you can put into your super in addition to what your employer puts in. And it also includes personal deductible super contributions. These are contributions of, say, you might have lump sums of a $10,000 amount that you can put into your super. You then claim it as a deduction. The super fund will deduct 15% tax from that, but you can reduce your personal income tax by that $10,000. Now, you're only eligible for this if you satisfy the 10% test. Now, the 10% test is the opposite to the government co-contribution. So you need to, this 10% rule that you need to satisfy is less than 10% of your total assessable income needs to come from employment purposes or reportable fringe benefits, for example. And the beauty of this one is that you can just reduce the amount of tax that you pay. Similar to salary sacrificing to super, but you can put in more lump sum. So if you're eligible, you could actually put in a lump sum now before the end of the financial year and reduce the amount of tax that you pay. But the important thing is that you need to be eligible. If you're an employed person, you're very unlikely to satisfy this 10% test. But if you have sold a significant assets and only working part-time or not working at all, then you potentially could make these deductible contributions to offset your tax. Now, somebody asked a question in relation to salary sacrifice, so I just thought I'd explain how this 10% rule works. How the 10% rule works is that if you've got employment income of $10,000, and that would mean that you would need to have non-employment income, so investment income, of $90,000 to satisfy the 10% test. So 10% of your total income coming from employment purposes. Now, another way to look at it is the other way. So if your total income was $50,000, to satisfy the 10% rule and make these contributions, less than $5,000 of it can come from employment purposes. So hopefully you appreciate how that 10% rule works, and then how you work out whether you're eligible to make these deductible type contributions. So Kim asked the question, if you're in the mid-50s, how much should I be putting in extra as a contribution prior to the end of the tax year when only working a 3-day week? Well, the first question is, are you substantially self-employed? That is, you satisfy the 10% rule like on the previous page. And if you're working 3 days a week, you're potentially not. And therefore, the only way that you can make these type of contributions to super is through salary sacrifice and reduce your tax, reduce your income that way. Now, if your only option is to do it through salary sacrifice, then you're basically limited to whatever salary you've got left for the rest of the financial year. So if you've got no pays due in the rest of the month, then you can't actually salary sacrifice anything else. But if you've got one pay left, you could potentially salary sacrifice all of that pay. Basically, you're limited to whatever pay you've remaining for the rest of the financial year. Now, if you are substantially self-employed, you can make these, what we call those deductible contributions, and you can claim a larger amount, up to the contribution limit, which this year is $25,000 per annum.